Every time the Fed hikes interest rates, your hard-earned savings are silently being eroded. But what if I told you that the Fed wants this to happen as part of a plan that could ultimately save the economy or destroy it? Prepare to discover the shocking truth about how the Fed controls your financial destiny. Interest rates are like the price of borrowing money. When interest rates go up, it costs more to borrow. Think of it like this. If you want to buy a house with a mortgage, a higher interest rate means you'll pay more each month. The Federal Reserve, often called the Fed, is like the conductor of the economy's orchestra. Its job is to keep the economy running smoothly, aiming for stable prices, low inflation, and maximum employment. One of the main tools the Fed uses is setting the federal funds rate, which influences other interest rates throughout the economy. When the Fed decides to raise interest rates, these are the Fed hikes you hear about. It's trying to slow down the economy. Why would they want to do that? Well, if the economy is growing too fast, prices can start to rise quickly, leading to high inflation. This means your money buys less than it used to. The Fed believes that by making borrowing more expensive, businesses and people will borrow and spend less, which can help to cool down the economy and bring inflation back under control. So, how does a Fed hike affect you directly? If you have a mortgage, your monthly payments might increase, especially if you have a variable rate mortgage. Credit card rates also tend to go up, making it more expensive to carry a balance. On the other hand, if you're a saver, you might earn a bit more interest on your savings accounts and certificates of deposit. However, the increase in savings rates often lags behind the increase in borrowing costs. Also, if you are interested in bonds, yields increase. The housing market can be affected too. Higher mortgage rates can make it more difficult for people to afford homes, potentially slowing down home sales and construction. The Fed's decisions aren't always straightforward. There's always a risk that raising interest rates too aggressively could trigger an economic slowdown or even a recession. It's a balancing act. The Fed also uses tools like quantitative tightening, which involves reducing the amount of money in circulation, which can also impact interest rates and economic activity. One thing we didn't fully explore in this video is the impact of global events and supply chains on inflation. These factors can sometimes make it harder for the Fed to control prices with just interest rate adjustments. This is an open question, and economists constantly debate the best approach. If you found this video helpful, please like, share, and subscribe to keep watching such amazing videos.